All right, we'll do one more question, then we'll turn it over to the audience for some Q&A. So Rachel, ASA, what do you guys produce? What can you do? What advocacy can you guys provide when it comes to assessing risk in investments?
Okay, so we do two main things. One is education. So that education is through, the magazine, the conferences, webinars. So we do education. We also do company monitoring. So we have a lot of volunteers. We have about 200 volunteers that monitor ASX companies every year. They go and speak to the chairs. They ask the tough questions. They stand up in AGMs. And so then they provide those reports back to all ASA's members so they can decide how they want to vote at upcoming AGMs. And that's the thing, a lot of us don't get around to voting for AGMs, but we really need to as investors. We really need to be engaged to give our proxy. You can give your proxy to the ASA whether you're a member or not. So lots of things that we have, but we're a not-for-profit. We've been around 60 years, and we're here to support and stand up for retail shareholders on advocacy, monitoring companies, and providing education.
Mark, Morningstar, you mentioned uncertainty ratings. Anything else that you guys produce around risk?
Yeah, I think, as I said before, in my mind, one of the most important things is obviously understanding the investments and understanding the businesses if you're buying shares, understanding what's in a ETF or a fund, if it's passive, if it's active, understanding the approach that a manager is actually taking to decide what goes in there. So, what I always say about our research reports, so we have teams of analysts cover equities and also cover funds and ETFs. What I always say is, people focus a lot on the ratings. Is a 4-star stock? Is it a 5-star stock? But just read the reports. And, I think more than anything, it's just understanding whether our analyst is right or wrong, understanding what's actually that investment means. And I do think that while they sometimes write like an analyst, and it's a little difficult to understand, I think what they really do is they really spend a lot of time, and if you speak to our analysts, that obviously I'm lucky enough to do, speak to our analysts, they really understand the companies and they really understand the products, and use that as an input into your own investment process. Because anybody, any analyst, any fund manager you read about in the newspaper or you see on ausbiz, they can provide insights that should go into your own process, because we're all different. We're all trying to accomplish different things. We're all comfortable with different types of investments. So just go out there and use those inputs. And I do think that our research reports are a good way to learn about the company. And what's important is not necessarily them telling you what to do, but them educating you on companies, on different investment products.
Yeah, what I discovered, I own a company called Ball Jar. They make jars, basically, in Colorado.
Appropriately named.
Yeah, that's right. But I learned from reading the Morningstar research that actually, because of their manufacturing process, they're like the leading provider of aluminium to NASA, because they've developed this way of making lids and things for jars at scale that are really high quality. And that's just the nerdy stuff you learn from reading those reports, basically. So.
And I might say that maybe it's the combination, because you look at a Morningstar analyst report, you can also look at Australian Shareholders Association, a voting intention put together by another retail shareholder. They're all sources of information that you take into making your own decisions.
Yeah, form a triangulated view, as it were. Danielle, any resources from ausbiz or your...
ausbiz has lots. We have lots of fabulous interviews.
Or your book, of course.
with companies, with fund managers. We also have the flagship program, The Call, where you can put in your requests for our expert guests to talk about a stock. We also interview people into other geographic locations, into the US, to get an idea of what's going on there, as well as Asia and the UK. And basically, it's the only dedicated business channel, live streaming channel, so you can watch it live on the app or on, sorry, this mic keeps moving, or on your computer, and I think it's on 7 Plus as well, but Kylie is at the back and Carolina, and they can confirm that. And the other thing that you can do is watch video on demand. So it's, a great platform from 9:30 to 4:30 to get a rundown from all the experts, what they're saying, what they're doing. And if you subscribe to the newsletter, you get to read me and my thoughts.
And you also get to watch Shani every month on her
Absolutely,
segment.
the beautiful Shani.
Yeah, that was a terrific discussion. We'll turn it over to the audience, but I'm happy we didn't get too technical. We didn't talk about sigmas and sortinos and things like that, but I'd be remiss if I didn't just remind ourselves that we're currently sitting in the beta function space, and downstairs is alpha, which is not planned, but strangely appropriate.
But where's gamma?
Gamma's upstairs. Okay, so with that, let's turn it over to the audience. If you've got questions for the panelists, or I suppose for myself as well, happy to take those on.
Is this directed at me as the American?
I'm hiding behind the veil of the moderator.
Oh, God, that's a tough one. I'm just very much not looking forward to it in general. But listen, it's very hard, obviously, to predict what's going to happen. I think certainly Trump has historically had very destabilizing impacts on one, I think, kind of geopolitical stance of the U.S. If we look at a lot of the unity around NATO right now and supporting Ukraine in the war, I think a lot of people are very nervous that that's not going to continue with Trump. A lot of the protectionism, particularly with China, has kind of continued. Obviously, the rhetoric turned down a little bit. But yeah, I'd say at the end of the day, it's probably going to be fairly messy. There's a lot of things that are happening right now that are certainly adding volatility to the markets. And regardless of who gets elected, I think sort of the run up to the election, which in the US obviously takes a very, very long time, probably isn't going to do anything to dampen any of that volatility. So I guess I would say that's probably what I would think that the biggest impact would be. I don't know.
Danielle, do you have any thoughts on that one?
Yeah, this microphone. It's a tough one, isn't it? I was surprised with the reaction when he got in last time. The market sold off heavily and then rallied, and Carl Icahn had been in buying furiously, realising that all these tax cuts and all these really company-friendly policies would be introduced by Trump, but obviously his agenda has changed massively. I guess we could turn it on its head and say, if it becomes like the US becomes quote-unquote a failed state or something of that nature, where on earth because US treasuries and US dollars are basically the world's collateral, and there is nowhere else in the world where that collateral can actually go. Like, if anyone wants to, get down into the weeds, there's a guy called Michael Howell from Cross Border Capital who does the best work on this in the globe, and I did work with him at Barings. And he's very free with his time. There's lots of YouTubes and things. So I have no idea. I'm dreading it as well. But all I would say is that the US treasuries are the globe's collateral for all the loans that are out there. So it begs the question, if you get a total meltdown for some geopolitical event, what happens? But you looked at the insurrection, markets didn't even move. It's quite bizarre. So maybe sectors will move. I have no idea, but sometimes I'm surprised, and I don't know what you think, Mark, or any of the panel. Sometimes it takes a really massive geopolitical event to shift investors and to a risk off.
Any thoughts?
I'll probably not get into the politics of it, but I think that's a really good point around sometimes there's a lot of talk or there's fluctuation in a day or a few hours or a half day that doesn't have a long-term impact. So it's really, really hard sometimes to have the crystal ball and what that means.
Yeah.
But I'll leave the American politics alone.
The reserve currency, I think, is a very interesting point, and I would agree with that. And I think it was Ray Dalio who said, that is the tipping point. If that is questioned,
it can't change. There's nowhere for it to go. I
Right.
mean, that again, there's lots of hype and everything. But seriously, are you guys all going to race off and put your money into, this new brick currency apparently that's backed by gold, or are you going to put all your money in Bitcoin? And that's the thing. It's when push comes to shove, the US government is not going to default on its debt. Whereas Russia did in 1998 and sent long-term capital management down.
Indeed. Next question. Yes, gentleman in the back. Yeah, in the middle. Yes. Chinese real estate, any takers, Mel?
I don't think you need to worry about global contagion. Again, if you want to dive into the weeds more on that stuff, Victor Schwetz, who you can follow on LinkedIn, who's the Macquarie strategist, he's a fabulously eccentric Ukrainian, again, who I had the pleasure of working with, who's written a big book on this called The Global Rupture. And I think that it's whilst there might be a couple of ructions, because I think BlackRock holds some of Evergrande's US dollar denominated bonds, but nothing appears at this stage to be systemic, and everything is basically within the closed Chinese economy. So, you know, he's written a piece this week on LinkedIn specifically about Chinese property. So if you're on LinkedIn, you just follow Victor and you can read the posts.
Mark or Rachel, any
it's
comments?
above my pay scale.
Yeah, I mean, I think the only thing that I would say about China, if we look at China on a wider basis, we need to remember, and I made that comment about the AFR and all the portfolio managers telling us to invest in China, now is a great time. But if we go back and look at the narrative, it's that as China got out of sort of the COVID lockdowns, that was supposed to be the engine that was going to drive the world economy, that Chinese growth would return. I don't think anyone's thinking that now. And, you know, and we go back even further. There was a point in time where people said that China would keep growing at 10% a year, GDP. Well, now they're at 5. And so 4. Okay. So yeah, I mean, I think that the narrative about China is sort of this growth story that we all became so enamored on is seemingly going away. And I think the question is, how does that impact everyone else? Not necessarily a blow up taking down the world, but just sort of that slower growth. And especially, obviously, if we look in Australia and look at some of the resource sectors, what does slower growth mean? Well, it's not going to be a blow up necessarily, but it's going to be, once again, a future that looks different than the past.
Yeah, and I'd only just comment on like Australian companies and the potential impact, and a lot of them that could be impacted are commenting through the earnings season there.
I have something on that. It's really interesting because I interviewed Will Hamilton of Hamilton Wealth down in America, and he goes to a big investment management conference in Monaco every year, and they were talking just about this, about how to let retail investors get a slice of the private markets, which have outperformed. When you come from an institutional background like mine, that is like the biggest red warning flag. It's like, because the retail market wants a slice of that pie, the institutional market goes, fabulous, we'll design the product for you and give it to you. And the problem with that is the weight of money from the retail market will drive the generation of the products, which means you have to be very circumspect about what you're buying into, because the institutional market, by design, wants to make money. There's quite a few cynics around, you know, why mutual funds were designed, why ETFs have been so successful, because for the business it becomes an annuity stream of income, ours, drip feeding into them. So the only thing I'd say, when you start diversifying into non-correlated assets, be it agri, be it hedge funds, supposedly, and they do go under, don't underestimate, you know, long-term capital management, you know, that was never meant to go under. That one in, you know, 500-year risk event, oops, Russia just defaulted, oh dear, we've got a systemic risk. So all I would say is, always put it in the context. You always hear the good stories. You always hear about someone that invested in Canva before they listed, or Atlassian before they listed, or, you know, why didn't I buy Apple at $12? Coulda, shoulda, woulda, big shame. But be really circumspect when these products come to the retail market, because they're not doing it for you. You are taking the risk. The fund manager gets you to sign away and say, you know, historical performance is no prediction of future. Well, we're going to do our best to outperform whatever benchmark they give you, but you're taking the risk. So that's someone that comes from institutional who's quite cynical about it, and that's why, as much as I sometimes listen to these alternatives, I just sometimes go, I'm just going to stick to my cash, my little house, and shares, because it's again, for me, who's sometimes possibly a nervous Nelly, a control thing. But if you do want to put your money in, it goes back to how do I asset allocate across that thing. I have to put in enough to make a difference to my performance over the longer term, but if it does go completely pear-shaped, am I comfortable with the loss? It's as simple as that. That's how I see it.
There's a saying that goes, financial products are sold, not bought.
Correct.
So
yeah, they're not doing it because they like you. Sorry, you have to be cynical though.
any comments, Rachel, Mark, on that one?
I would just say, like, some of them that I have seen, and again, it's a personal decision, is, the high amounts that you need to put in, and also, sometimes things sound too good to be true. So I might be a bit too conservative as well. I've heard some different things around this amount, you'll get this percentage, and it's just not for me. But if you're going to go that way, again, it's all about research. Do your own research, make sure you feel comfortable and it's aligned with your risk tolerances, because we're all different and we've all got different strategies.
Yeah, I mean, the only thing I would add is, personally, I wouldn't touch that because the fees are too high. And ultimately, and it's the only thing I would add, I agree with everything you said. Why are they introducing this stuff? Because the fees are higher. And so I just don't buy it. And I am like, if you look at any returns of any products, fees have a huge influence on those. So if they want to start lowering the fees to what you would pay for an index fund, then that's great. And the other side is, I don't necessarily, and there's been a lot of talk about it this year with some of the super funds, but I don't necessarily buy the returns either. Like, it just doesn't fundamentally make any sense to me that private equity, and I'll tell you the reason I think it's this way, but that private equity has such high returns at this point when there's so much money in it, right? This isn't like the beginning of private equity when there are a couple people doing it. There's so much money in private equity, and they keep telling us the returns are higher, but why are they fundamentally higher than public companies? They're all operating in the same economy. They're all selling the same products, and I think it's because of debt. So they've loaded up on a ton of debt, and as we talked about how environments change, how are they going to do in this world when it costs more to go out and get debt? And so that's one concern. And then, of course, yeah, we've read about these super funds, and we look at, retail real estate investment trusts, and then we look at what some of these super funds are holding unlisted property at. The valuations are stickier, right? So at the end of the day, they tell us how it's lower volatility and it's uncorrelated.
So just don't revalue them.
Yeah, they just don't change the valuation. So it's like, if I don't look at my brokerage account when the market's fallen, in my head I'm like, oh, well, it's still worth this much. Like that's not necessarily the value of those assets. So I guess I just have some concerns around that. And kind of the last thing is that uncorrelated nature of it. For me, and for some investors it could be very different. For me, I'm not really worried about correlation between different assets in my portfolio. I still have a while to go before retirement. I don't really care at this point. If the world blows up and everything's going down and something goes up a little bit, well, that doesn't really do anything. What I'm trying to do is look past that and figuring out where are we going to be in 20 years. And that's my view, by the way, and not Morningstar's, just in case anyone is taking that as a Morningstar view.
Further questions?
I don't really use technical analysis, but if it picked Apple at $12, go your hardest. We know that in hindsight, but I don't know how a chart when it was $12 would have told you it would have gone up thousands of %. I mean, technical analysis is good till it isn't good because it's very short term. Yes, I know there's the Krondorf, or however you pronounce it, long wave theories, but I think that it's a tool if you appreciate it with its limitations, what it can do for you versus what it can't do for you. It's always about knowing the limitations of the tools that you are using and working within those parameters. Because I go back to, there is no silver bullet. You're not going to get everything right. And are you holding a company like CSL, which is a great long-term performer, because you think that they will get it right over the next 20 years, or do you think because they've had a change of management and the pandemic has irrevocably changed the business? So as always, it goes back to the boundaries of how you invest. If technical analysis works for you, that's great. But just appreciate, like every other bit of analysis, in my humble opinion, it's not a recommendation, everything has limitations. There's a great, Martin Kemp has written another book, one of his first books, Uncommon Sense. He got to finally go to the big Berkshire Hathaway meeting where thousands of people queue up, and then he did the course all about how to invest like Warren Buffett, and he's asking the questions, how do I do this, how do I do this, like what does Warren do that's so different? And they all say he reads, and he speaks to management, but he reads all day long. That's his success. So I think investing is very personal. Everybody has a different thing. If it was reading tea leaves that works for you, that's absolutely fine. But clearly companies like Morningstar, like ausbiz, like the Australian Shareholders Association, they don't necessarily, ausbiz has technical analysts, so you can definitely listen, but it's all very varied. Not all analysts are wrong, and not all technicians are wrong, but none of us are right 100% of the time.
That's well said. Anything to add to that, Rachel or Mark?
That was pretty perfect.
Yeah.
You did really well.
It reminds me a little bit, I mean, I agree, it should be a tool in the toolkit, not the end-all, be-all. The parallel that came to my mind was analytics in sport. And analytics, I'm a baseball fan, analytics has ruined baseball. And golf too.
That golf swing,
absolutely.
keeping it on plane.
Yeah, and it just you can see these decisions that are made by sporting clubs, professional or otherwise, that are purely analytic driven. They make no sense. It's just like, have you been watching the game in front of you? That guy sucks, or that guy's hurt. And I worry about that overtaking the, shall we say, the Warren Buffett element, where it's like common sense, just common sense, in addition to technical, which can work very well for some people. Absolutely.
But you forgot the thing about common sense. It's not very common.
No, it's not. No, it's not.
I would just say when we're looking at companies, we're asking them questions around risk, and climate change is a risk. So we do want to know what they're doing. Also, all companies need to address it. There's mandatory reporting coming out. So it's not long till there's that mandatory reporting, which is two things. It will be able to identify the risks and report on it, but also ensure that there's no greenwashing. So looking at the flip side, so really clear targets and KPIs there. Yeah, so all companies, I think companies are actually quite advanced in what they're doing at the moment around the climate change and the risks. And maybe the difference sometimes as a retail shareholder is we don't know that, see it, or sometimes we have conversations with investors around return on money versus ESG. You want both. You want a company that's doing the right things, that's going to be sustainable, financially sustainable, and sustainable in the long run. But I think that all companies need to think about what their risks are, and it's coming anyway. So whatever we personally believe, companies do need to report on it very soon.
Comments from Mark or Danielle?
I think it's a really interesting question, because not only in Australia but globally, costs of just existence are going up so dramatically because of extreme weather events, and the amount of extreme weather events is going up as well. I disagree with Rachel about Australian companies being prepared. I think they've got a lot of blinkers on in the boardroom. Some are probably a little bit more on top of it.
And it might be size of company too, potentially.
No, I don't know. I just think it's really hard for everyone to get your head around. I've had thought about it long and hard and spoken to other people. It's like it's such a big existential risk that I think everybody sometimes just wants to close your eyes to it. In terms of how you manage your portfolio, I think the insurance companies are a really good example. Like, everybody loves them at the moment because they've been putting up their premiums. I've written about it. I wouldn't buy an insurance company, you know, no way, because the reinsurance risk, Munich Reinsurance, all the big ones, they've been calling out climate change for years. And yes, I've been down the rabbit hole for many years on this one now, and costs of everything are going to go up, which also I have still been looking for. So if anybody knows anybody that can come and talk to me on ausbiz, I have been looking for someone to come and talk about, like, for example, with these risk events, if food prices go up because of climate change, our traditional tools of how we deal with the inflationary impact just go splat. Because, you know, we say we put up interest rates because inflation is going up, but yet it's you know, a massive driver from behind. So I think there's a lot of unknown questions. How you manage it in portfolio, look at the stocks and say which ones are potentially very, very vulnerable. To me, insurance companies are just a standout. Short term, premiums going up. Longer term, they're not insuring whole chunks of areas. Insurers have left California, they're leaving Florida. I'm talking, you know, home insurance, etc.
Anything to add, Mark?
Yeah, I mean, I think the only thing I'd say is I do think it's a really good point, and you know, there's so much controversy right now, and like particularly in the U.S., but also in Australia around ESG. And Rachel and I were actually speaking before we came up here, and you know, if we publish an article on our website on ESG, no one reads it. So it's sort of the instant way that we know we're not going to get many hits that day.
And if they do, they fight in the comments.
Well, yeah, exactly. And but there's so much controversy over ESG, but as investors, we've spent this whole panel, for example, talking about risk. It's a risk. So ESG does not mean that this is some hippie that's telling you, like, you know, you can't drink out of a plastic straw. It is looking at a holistic set of risks that impact a company. And climate change will impact companies. They will have to spend a lot of money. That's not good for us as shareholders. And it's going to change the way that companies operate. And so we have to take that as a risk. And we have to consider how that impacts different companies. And so I think it's just become this political discussion, and the political discussion really has nothing to do with investing. So you can have all sorts of views on what we should be doing as a society about climate change, but as an investor, you have to figure out, will this impact the company that I'm investing in or not? And I mean, I think that's just something that we have to consider as investors.
Yeah, and the ESG stuff too, I spent some time reading about it. I did a presentation internally on it. I mean, you go down that rabbit hole and it's a classic case of well-intentioned, yet you implement a policy and then it has these unintended consequences over here. It's a bit like whack-a-mole in a sense, but we are out of time, I'm sorry, for questions from the audience. We need to take a 15-minute break and then reconvene at 4:35. Please join me in thanking our panelists, Danielle, Mark, and Rachel.